All right, well, speaking of investors, both the Dow and the S&P are now within 10% of their all-time highs. The NASDAQ, of course, is at a new record. Is all of this because the world, not just the United States, but the world is throwing trillions of dollars at the economic slowdown? Joining us now is David Waddell. He is CEO of Waddell Associates. David, thank you very much for joining us. Is this really just all about the stimulus trade, or do you believe, like Stephen Schwarzman of Blackstone said the other day, that maybe there is going to be a faster recovery than the market, well, not the market, but many people may have originally have thought?
I think it's both. I think the amount of stimulus that's been deployed is dramatic. I mean, we've seen 3 times the amount of fiscal stimulus we saw during the great financial crisis. We've seen 2 times the amount of quantitative easing across the planet we saw during the great financial crisis. So it's a $90 trillion economy, and the global authorities so far have thrown $15 trillion at it. So they've basically bought 17% GDP. That's pretty amazing. But also, if you look at what's going on inside companies, everybody's leapfrog. It's almost like Y2K in terms of their technology during recessions, which are natural events. This has been an unnatural instigation, but they're natural events. Companies go through austerity programs. They right size staffing levels, they improve their strategic bent. So we may see a surge in productivity coming after this. And by the way, I find it somewhat humorous that we're always debating the shape of the economic recovery. They're always V's, right? So if we get a U, it's because the government has done enough to really suppress the animal instincts that drive us naturally anyway. So I think, yes, we've had a tremendous amount of stimulus, but also we sort of underestimate the animal spirits within the economy, not only here, but abroad.
Yeah, and listen, not everything is analogous, but we've got to remember, David, that this is the 4th pandemic in the last 100 years. Of course, we always focus on 1918, but there was 1957, which was very deadly, and 1968 as well. And when you look at the markets, especially 57, the markets, of course, things are very different now. I get that. I'm not making a direct comparison, but the point is, after recessions, after 57 as well, markets were far higher than they are right now. Do you think there is any historical comparison to be made to now?
I do. Actually, I think your choice of 57 is appropriate. So that was the Asian flu. We had 100,000 people die in the United States. The population was half the size, so that'd be analogous to 250,000 today. We did have a 10% drawdown in GDP in Q1 as the fatality rate spiked. And then GDP went on to ride at about a 9% level. Markets rallied 58% pretty quickly and 90% over 4 years post-pandemic. So that was, of the 4 you mentioned, the only one where we had a bear market, we had a recession, and we had the kind of pandemic activity we're seeing today. And there was a vaccine, by the way, but it was only 60% effective. But you ask people about 57 and they don't remember it. We had another one in 68, 69, and people don't remember it. And in fact, the market went up during that period, and we had Woodstock. So people were congregating. I mean, what's been different this time is sort of the Twitter virus that has no vaccine that's got us all terrified, and obviously bringing in government regulations, which aren't necessarily bad. But I think we've gone from being a quarantined economy to being a face mask economy. And that's why you're seeing a bunch of better than expected economic results, because people really want to get out and spend money.
I hear your point, David. I don't want to debate the pandemics, and certainly it is very dangerous to a lot of people right now. I don't want to minimize the effect of COVID-19. It has been deadly. A lot of families have lost loved ones. We certainly understand that. But your point on 57, we have talked about this on this program, and I've tweeted stuff out for the last couple of months, was that we forget 57. I mean, it was, to your point, on a percentage of the population, it was a very dangerous time as well. But when it comes to the markets, when it comes to the economy, are the markets related to the economy right now? Do stocks have actually anything to do with the economy right now?
I think they do. Again, I think 2020 is a throwaway year. Everybody knows that. So we're now all looking forward to 2021. And right now, the analysts could be right, they could be wrong, but the expectations are that earnings, which are a result of what's going on in the economy, will be back to 2019 levels. Now, typically coming out of recession, and I haven't done the work on 57, but coming out of recession, analysts underestimate the power of earnings by, call it 10%. So if you gross that up to 180, you look at the multiple today, then yes, we're going to get that economic traction. That stimulus, by the way, has only been like 50% deployed. I mean, if you look at the Main Street lending program, it hadn't even started yet. So there's still a lot in the tank, and case rates are rising. And in my head, every time the case rates go up, the stimulus amount goes up too. One of the things we don't talk enough about is that the fatality numbers are actually coming down. So case rates are going up, fatalities are coming down. There might be a lag, and that'd be bad news. But if you fast forward, you know, if you're betting against the markets now, you're betting against the president, you're betting against Congress, you're betting against the Fed, and you're betting against the scientists. It's just too big an oppositional party to be short this market, I think.
Yeah. All right, David Waddell there. David, we appreciate time this morning. Thank you very much. Appreciate it.
Great to be with you, Brian. Thank you.